Hi, thanks for joining us. Today I'm talking with Simon Blanchflower from Altrinsic Global Advisers about the current portfolio positioning. Welcome, Simon.
Good morning, Jason. Thanks for having me here.
So Altrinsic is a global value manager. What does value actually mean for Altrinsic?
Value for us is really finding ideas that trade at a discount to their intrinsic value. So margin of safety is very important to us. I guess in terms of where we're a bit different though is that we don't compartmentalise value. We invest right across the value or the quality spectrum. So we hold positions that are of higher quality, where return on invested capital is greater than cost of capital, for example, so highly productive companies, as well as those that have more cyclical features, profit normalisation stories, which are much deeper value type situations.
So how has value really performed over the last few years?
It's been difficult for value now, probably 10 years. There's been periods in between where you've seen some value outperformance, but generally speaking, you could quite easily argue it's been a growth super cycle.
2016, I think, was a particularly good year for value, is that right?
Yeah, actually 2016 was the first year where you had a substantial recovery in value, which was largely driven through cyclicals and emerging markets.
And do you see that outlook for value changing over the coming years?
Well, this year actually, although we had a great year last year, that year's completely snapped back now. So that super cycle I spoke about with growth is well and truly entrenched, it seems. I think the key thing for value, there's probably a couple of areas. One is a normalisation of volatility, because risk expectations are incredibly low right now, and that should normalise. The other is the pathway for interest rates. So if interest rates start to normalise higher, that should also be a good environment for value.
Well, you've seen the US Fed come out and talk about rate rises this year and next, and plus the QE program is starting its slow unwind. So do you think that will be a tailwind for value managers?
It could be. I think central banks reducing the size of their balance sheets, reversing QE. That's certainly, as you say, coming along. I guess the key question that we're all asking ourselves is whether you'll start to see wage inflation or not, because if you look at share of profitability in recent times, Labour's not seen much of that. So wage inflation is something to keep an eye on.
So within the portfolio, where are you seeing value at the moment?
Well, the markets are elevated, so it's not an easy environment to find ideas that trade at a discount to intrinsic value, but nevertheless we have a portfolio that reflects that, and we're pretty comfortable with that. The key thing with the portfolio, though, is finding those ideas that are idiosyncratic. Ideas that are not correlated to each other or not correlated to the market, so very business-specific ideas. That's the important theme for the portfolio.
And what do you think investors should be focusing on over the coming months or year?
Well, the key thing that we all need to watch is whether if earnings growth continues to come through, because we would argue that markets are quite elevated and earnings need to play catch-up. So we've certainly seen that this year. The earnings results so far this year have been quite positive, particularly in the United States and Europe. But you need to see that continue to justify where the valuations are today.
Great. Well, many thanks for your time, Simon.
Oh, thanks for having me.
And thanks for joining us.